country, but here in the UK, it's pretty dire. We're all in lockdown, we're stay at home, self-isolation. Even if we go out to go shopping or go out for exercise for limited periods, we have social distancing, and it's very, very difficult. Most businesses are closed down at the moment, apart from the essentials, and a lot of businesses are finding it very tough indeed. But this crisis won't go on forever, and we must all take an optimistic view of the future by taking the necessary action now to secure our survival and also our future growth. And to do this, it's essential to provide the necessary strong financial base. My name is Tony Davis. I'm a qualified accountant, business consultant, and training provider. You can read more about me in the profile, which you'll receive along with the PowerPoint presentation that accompanies this webinar. As we go through this webinar, I'll give you time to read each PowerPoint slide, but I'll talk over the slides to give you a clear understanding of the points that we'll cover. A lot of the terminology and the jargon may be familiar to most of you, but maybe not to all of you. I will explain where I can. I'll explain the terminology and the jargon as we go through the webinar. But this is not a training course. You don't need to be an accountant either to understand and apply the techniques we will discuss. This webinar is not about theoretical accounting. It is about practical finance tools to help you, particularly in the current pandemic. Please raise any questions that you may have using the question screen icon, and I will leave time at the end of the presentation to try and answer them. Okay, the coronavirus pandemic, and by the way, coronavirus refers to a range of similar diseases and things like flu-type diseases, even colds. But COVID-19 is specific. It relates to this particular virus. So who is affected? Well, we're all affected by this crisis. We're affected by the uncertainty, the lack of knowledge. It's unprecedented. It's terrifying. We're concerned about what's going on. It's very worrying, and we continue to ask, how long will this go on? All the stakeholders of an organization are concerned. Who are the stakeholders? Well, stakeholders are employees, managers, directors, the general public, government, the customers that we supply, and the suppliers and the vendors that supply us. Stakeholders are concerned, for example, with salaries and wages, fees payable to employees, directors, or subcontractors. Also, dividends payable to shareholders. Shareholders are stakeholders, and they're worried about their dividends paid on their shares. Interest payable on loans, payable to banks and other financial institutions, and continued supply to customers and whether they can pay for that supply. Customers, by the way, are the people to whom we sell our goods and services. And also continued supply from vendors or suppliers, and whether we can pay for what they supply. Vendors or suppliers are the people from whom we buy goods and services. And then there is also payment to government for VAT and also other taxes. So what can we do? Well, in order to evaluate and plan how to deal with each part of the business, we need to assess the organization in terms of what is not affected by this pandemic Can we therefore maintain parts of our business plan intact? And what is affected by this pandemic? How can the impacts of these changes be assessed and planned? We need to consider changes in each of the examples of the areas of the organisation that I've listed in the slide and our possible responses to these changes. For example, if we take a couple of them, HR policy. Well, rather than laying off employees in this difficult time, many employees are able to work from home and still remain employed. And maybe furlough leave with possible government help. If we consider operating costs, we can analyse what is called operating gearing. And operating gearing is the percentage of our fixed costs compared to the total costs of the organisation. And we can consider which fixed costs can we possibly reduce, and maybe we should be looking at cancelling discretionary spending like advertising and promotion. So what are fixed costs? Well, fixed costs in the long term, all costs are variable, and that means that they will change over a period of time. But in the short term, and by short term, we're talking about periods up to 1 year. Some costs may be fixed, so they remain unchanged over that particular period. A fixed cost is defined by two things. Firstly, by time. So a fixed cost, a cost may be fixed for a period of time, a specific period of time, but also determined by the level of activity. So for example, rent may be a fixed cost. Rent may be fixed for the period of 1 year. At the end of 1 year, it may be increased, and then it may be fixed for another year. Another example is insurance premiums. These again are fixed costs, and insurance premiums and many other overhead costs. Now that is over a period of time. But also if we consider the level of activity. With a level of activity, for example, if you planned a level of production over the period of say 6 months or 1 year, maybe you have fixed costs for that particular level of production, of operation. But say, for example, halfway through the year, suddenly your demand doubles. Well, therefore, you've got a bigger production capacity requirement, and therefore maybe you need more property. If you need more property, you may have to rent that property. So therefore, your rent will increase part the way through the period, even though it's a fixed cost. So fixed cost is determined by time and also level of activity. And some of these costs are very difficult to get out of, but it's not necessarily impossible. We'll discuss each of these variables in the areas that I've listed shortly in terms of cash flow and credit, which are the basis of this particular webinar. Now, these are financial essentials in periods of crisis like the one we're currently facing. When we talk about cash and cash flow, we certainly don't mean profit. And when we talk about cash and cash flow, these include not only notes and coins, they include bank balances, bank deposits, minus any bank loans that we may have. Credit is defined as the amount of time and monetary limit that is allowed to pay for things either sold to our customers or maybe bought from our suppliers. Crisis management really in today's situation is now business as usual, and the impact of this pandemic affects us all in very different ways. But cash flow is the lifeblood of any organization, regardless of which industry or which sector of the economy we're in. But what is cash flow? Well, for a business or an individual, cash flow is all the money received minus all the money paid out from and two, all sources over a period of time. It could be 1 day, 1 week, 1 month, and so on. Cash flow does not include money owed or due to be received or paid. It only includes actual cash received and paid. A cash balance is the positive or negative cash position, notes, coins, bank balances, etc., at the start of a period and at the end of the period. Each element of cash flow, the various sources of money receipts and payments, must be clearly understood with regard to what is unchanged and what has changed in our current situation, as we've discussed earlier. We can then consider what money will be received with relative certainty and what cash must be paid. And then we can look at what benefits we can negotiate with our banks and our key customers and key suppliers. When we're looking at cash flow, we must take a realistic view so that we can prepare maybe for the worst situation to happen and be pleasantly surprised if things turn out better than expected. So a careful and prudent approach is needed to analyze cash flow. Cash flow and treasury management is an important element of financial management. And as I've said, all organizations do treasury management. And treasury management is this area of financial management that deals with, first of all, where we get our financing from and managing our liquidity, our cash flow. Secondly, it looks at how best to invest our surplus funds to create additional value while minimizing risk. In this webinar, we're concerned with the first element of treasury management, dealing with liquidity and financing. The second element, investment, is not covered in this webinar. Now, liquidity and financing consist of three components of cash management, working capital management, and financing facilities, each of which we'll look at in the following slides. Now, it's very important to emphasize again that here we are not talking about profit, which is not the same as cash flow. Many accountants place too much emphasis on profit and its related profit margin ratios. It doesn't follow necessarily that it creates shareholder value, and shareholder value is created from an increase in the market share price of a particular security, plus dividends paid by the organization to shareholders. And to pay dividends, you need cash flow. You also theoretically need to make a profit, but cash flow is certainly required to pay dividends. Profit is an important measure, but it is just one measure of financial performance. And if you report a profit, it doesn't necessarily mean that you also have cash. Say, for example, during a period, you buy something on credit for $100 and sell it on credit for $200. You've made a profit of $100 for the period, but you have no money because it was all on credit. You have no money yet. You may have money sometime in the future, but you don't have it in that particular period that you've quoted profit. So what is profit? Well, profit is sales revenue minus cost, total revenue minus total costs. It includes cash transactions. It also includes credit transactions, but it includes a lot of other items too. It includes something called depreciation as a cost. Now, depreciation is, for example, if you buy an asset, say 5 years ago for $100,000, you pay for that $100,000 at the time you buy the asset. But the cost of that asset may be spread over what is called its economic life. Now, you may decide that its economic life may be, say, 10 years, and therefore you may decide to spread the cost of that asset, $100,000, over 10 years. So it's $10,000 a year. Now, that $10,000 in year one, year two, year three, and so on for 10 years will appear as a cost. It is not cash, because the cash was when you bought the asset originally. So depreciation is a non-cash item that appears in the profit or income statement, as we call it. The income statement also includes other items like, for example, something called doubtful debts. When you make sales to customers, you make sales on credit and you assume that in due course they are going to pay that money to you, but they may not. So it is prudent for most organizations to make an allowance, or what is called a provision, for doubtful debts. Now, what this means is you may say, well, I'm going to assume that 1% of my receivables from my customers is not going to be received over the next year. So I will make a provision, an allowance for 1% of the value of my receivables, and I'll include it as a cost in my income statement. So again, it's not cash flow. There are also other items in the income statement, things like adjustments to the valuation of inventory, things like valuation of other assets. These are all non-cash items, but they appear in our profit. Cash flow, on the other hand, only includes cash items. There are no credit items. It is simply what we receive from our customers in cash, what we pay out to our vendors, our suppliers in cash, but also it includes some other things. For example, it may include assets that we purchased. It may include money that we've received in. If we have loan from a bank, for example, we'll receive cash in from the bank. But we still owe money to the bank, but we actually receive the money in the form of a loan. We may also receive money in from shareholders. If shareholders are putting money into the company, then therefore we're receiving cash flow. Profit for a period may be converted into cash flow, or parts of it may be at some time in the future, but maybe not all of it. And we may not be certain when that cash flow is actually going to be received. So the first component of liquidity and financing is cash management. And this is the first of the three elements I mentioned, which we'll look at first. So why is cash flow so important? Well, obviously, cash is needed to meet immediate financial requirements like paying salaries and wages, for example. Ultimately, all transactions should be converted into cash, like a sale on credit should eventually be settled with cash by our customers, but when? It's all a question of timing. Cash flow is timing. You may not have cash flow today, you may not have cash flow tomorrow, but maybe next week you'll have cash, maybe next month you'll have cash. It's a question of timing. If you assume, for example, my business made a very good profit last year, so I decided, well, I'd like to use some of that profit to buy a new computer. If I go into a computer store, choose a computer, the guy will then say to me, how would you like to pay? And if I say, well, actually, my business made a very good profit last year, I think I'd like to pay with profit. He'll look a bit confused and he'll say, well, I'm sorry, we don't take profit here. We'll take a bank transfer, we take cash, we'll take credit card, but I'm very sorry, you can't pay with profit. Profit doesn't pay the bills. Cash flow is needed to pay for things. Now, the fundamental essential tool required to manage cash flows and cash balances is cash forecast modeling. So, for example, you may forecast for 1 week, 1 month, 3 months, 6 months, whatever period into the future. And by the way, this tool of forecasting and many other financial tools and techniques are covered in detail in many of my training courses, which you may like to attend. So a cash flow forecast model can be set up using Excel, and each line of the forecast must include all the cash flow variables and the key drivers relating back to what we discussed earlier about which factors in the current circumstances may have changed and what remains unchanged. Each type of cash receipt and cash payment must be evaluated and included in each of the future periods of the forecast. Now, this must be done realistically and prudently. An over-optimistic cash flow is really not very helpful at all. If the resultant cash flows from the forecast for each future period don't look viable and do not indicate solvency, and solvency means having enough cash resources to meet your commitments, then if you don't look to be solvent in future periods, then opportunities must be explored to improve the forecast, which will usually involve looking at creative ideas and also the working capital and financing facilities, which we'll come on to shortly. Creative thinking and innovation is essential to try and find ways around cash flow problems. An example of this, a current example of this, here in the UK, dairy farmers normally receive a very low price per litre for the milk that they produce, and they supply through normal supply chain channels. But currently, dairy farmers, the dairy farming business, they have big problems. There is a huge drop in demand for milk at the moment because of lockdown, of cafes, Costa, Starbucks, and so on, but also the thousands and thousands of restaurants, hotels, etc. Now, these are big users of milk, which now the dairy farmers can't supply. So a great deal of milk is being produced at the moment because in this country it's springtime and the weather conditions are right for producing milk. But too much milk is being produced at the moment, this time of year, which now has to be poured away and therefore wasted, and therefore it earns no revenue for the farmers at all. So some dairy farmers, in response to this problem, have decided to sell milk directly to customers using vending machines. And the interesting thing is the price they get is at least 5 times the price they get through their normal supply chain channels. But also it's cheaper for the customer than they pay for milk in the supermarket. So preparation of a cash flow forecast model obviously needs the knowledge of how to do it, but most importantly, it needs good information and it needs good communication within and outside the organization. Most organizations work in what are called functional vertical silos. These are bureaucratic chimney-like structures which usually result in poor or slow communication. This pandemic has quickly shown organizations, particularly those in the health sector, distribution, and food sectors, that flatter structures, or what is called cross-function organization, are necessary for good communication and speedy sharing of information in order to get things done. And this is crucially important also for meaningful cash flow forecasting. The problem that we also have is that sometimes information is not shared by many organizations. Some organizations are very secretive about cash flow information and also other financial information. Let's look at the second area of liquidity and financing, which is called working capital. And working capital includes cash and bank balances, minus short-term loans, but also something called the working capital requirement. As I've shown on the slide, working capital requirement, receivables, inventory, payables. So working capital requirement includes these three elements. Receivables is money for collection from customers. Inventories are materials, work in progress, finished products, spare parts. And payables is the money that needs to be paid to our vendors or suppliers. Working capital requirement is measured by something called the operating cycle. Sometimes it's called the working capital cash operating cycle, or maybe sometimes the working capital operating cycle or the cash operating cycle. I think operating cycle is a good enough label. And what operating cycle measures is the number of days it takes to turn money around within the organization in the short term. And the lower the number of operating cycle days, the better the cash flow. So the formula for operating cycle days is receivables, receivable days, plus inventory days, plus payable days, minus payable days, should I say. So receivable days is the average days customers take to pay us, plus the inventory days, which is the number of days in inventory we hold on average, minus payable days, which is the average days we take to pay vendors. Okay, good management of this operating cycle can have a significant impact on cash flow. The receipts from customers, the payments to suppliers, and the optimization of inventory levels. This is often not given the attention it should be given by organizations. Sometimes organizations focus more on the bigger numbers of project expenditure, capital expenditure generally. But managing the operating cycle is very important at any time. But particularly in the current pandemic, it's crucially important to explore every avenue, every opportunity, every possibility of generating cash flow. If you compare, for example, different types of business, different types of industry, if you look at a supermarket doesn't have any receivables because when you buy items in a supermarket, you pay on the way out. And if you look at the inventory in a supermarket, it's turned over very quickly. As soon as things go off the shelves, they're quickly replaced. But if you look at payables, the suppliers to supermarkets, some supermarkets are very bad in the way they pay their suppliers. They make their suppliers wait a very long time before they pay them. So if you calculate the operating cycle of a supermarket, if you take its receivable days, which is 0, plus its inventory days, which is quite low, less its receivable days, which is relatively high, it may even have a negative operating cycle. So it may be that actually supermarkets actually receive the money in before they pay the money out. But if you compare that with a manufacturing company or engineering company, generally a manufacturing company has a relatively high level of inventory. And this is because such a business has to maintain high levels of materials, high levels of finished product in order to meet customer demand. So fairly high levels of inventory, and also including things like work in progress. But receivables days are going to be fairly short because, or fairly long rather, because customers will not pay necessarily very quickly. But payable days, on the other hand, will be fairly short because you need to pay for your materials in order that supply of materials is not stopped. So you have to keep your suppliers relatively happy. So the manufacturing company operating cycle is going to be fairly long number of days compared to the supermarket, which may be 0, it may be negative, but fairly low. So each different sector of the economy, organizations within those sectors are going to have different operating cycles. Development of trust relationships with customers and suppliers would enable a continual dialogue with those key customers and key suppliers. Now, this is important because then you're able to discuss and negotiate how business may continue to our mutual benefit while minimizing any adverse cash flow. Very often, this type of trust relationship has meant development of something called an open book policy between customers and suppliers, where the trust relationship extends to the sharing of cost and profit information between organizations for mutually beneficial decision making. Now, extended credit based on trust relationships during these difficult times is a powerful aid to try and keep business flowing. Maintaining inventory levels at optimal levels must be done without jeopardizing operational and customer requirements. You've got to keep enough inventory in order to meet production requirements, and also you have to keep enough inventory to supply your customers. But generally, lower inventories means lower costs. Cost of space for keeping inventory, the cost of handling inventory, and also there will be less damage, less loss, and less obsolescence. So optimizing your inventory levels obviously has a big impact on cash flow. Surplus inventory may be sold off to get cash, even if it results in making an accounting loss. That's not the important issue. The important point is to get to cash flow. The third component of liquidity management relates to financing. The capital financing of an organization includes equity, which is funds provided by the owners or the shareholders that does not have to be repaid. Debt is the other element of capital financing, which are the funds provided by lenders, and this must be repaid. So two different types of capital which comprise the total capital financing of the organization. With equity, shareholders' equity, dividends may be paid on equity, but they don't have to be paid. They're not compulsory. But debt, interest is paid on debt, interest is paid to lenders, and not only must the debt eventually be repaid, but interest must be paid. It is mandatory. Now we can measure something called financial gearing, which is a percentage of the debt, the total debt of the organization, divided by the total financing, the debt plus the equity. High gearing, high financial gearing means a high percentage of debt. Low financial gearing means a low percentage of debt. But why is gearing important? Well, it's important because an organization with high gearing is very vulnerable, because high debt also means something called high financial risk. And financial risk has two elements. Firstly, it's the risk of the organization not making enough money in order to service its debt, to pay its interest. And remember, interest must be paid whether you're making a profit or a loss. The second element of financial risk is that there may be changes to the interest rate. Now, over the past decade or more, interest rates worldwide have been relatively low. And so organizations, corporates and individuals have got used to very low rates of interest. But that may not go on forever. And interest rates may go up, and that is another particular vulnerability. The dangers of debt were emphasized during the last financial crisis. Following the dot-com bust in the early 2000s and also then 9/11, the United States Federal Reserve cut their interest rates to 1%, which at the time was a relatively low a low rate of interest. And they did this to try and regenerate the US economy. This resulted in cheap money and lots of borrowing by businesses and banks, but also individuals, particularly for property. And property always seemed to be increasing in price, and therefore buying property seemed like a good idea. Now, at this time, what are called subprime mortgages were arranged by lenders to people who had no deposit, they had no proof of income, and they could barely afford to make repayments of their mortgage. Now, these mortgages, particularly this big volume of subprime mortgages, were packaged by bankers into something called collateralized debt obligations, called CDOs. Now, these were sold to bankers and other investors, and from those investments, they received returns in the form of mortgage repayments. When the mortgage repayments were paid every month, those were the sort of trickles of money that received into the CDOs, or the holders of the CDOs. But because most of these were subprime mortgages to borrowers that could ill afford to have those mortgages, they very soon defaulted on their mortgage repayments. And also the flow of money to the banks for their CDOs also started to stop. The bankers then repossessed the properties because borrowers couldn't repay their mortgages, and there then became a glut of property on the market. More and more borrowers defaulted on their mortgages, so more and more homes were repossessed by bankers. The bankers then had a big problem because there were so many properties on the market that they couldn't sell them. And because of this glut of property on the market, the value plummeted. And they weren't worth anywhere near what the borrowers borrowed, and therefore the borrowers simply walked away from their property. CDOs became worthless because they weren't getting mortgage repayments paid to the investors, and banks started to go bust. And that started with, you probably remember, Lehman Brothers in 2008. The bubble had burst, and it affected then not just the USA, but it affected the whole world. What were the underlying causes then of this 2008 financial crisis? Well, firstly, it was the dependency by developed economies on the housing market. Secondly, interest rates were too low, so money was far too cheap. Thirdly, there was too much reliance on debt, both corporate and individual debt. And also there was a lowering of banking standards and a lack of an ethical and moral compass. Now, lessons should have been learned from 2008, but unfortunately they were not. So businesses have continued to borrow, and the level of borrowing currently is at unprecedented levels. However, for debt holders, lenders, and also for shareholders, it's not generally to the long-term benefit for an organization to go bust. Generally, it's more beneficial to keep organizations afloat. So if an organization can't pay the interest on its loans or can't repay loans, it isn't necessarily the best strategy to just make that business go bust. It may be better to keep that business afloat and continue to do business, because then, you may reap the rewards from their future development and growth. In the future, then more dividends may be payable, and also financial services for bankers in the future. The third component of liquidity management, I think we've covered that. In the current pandemic, in particular, an increased level of dialogue with your banks and shareholders is advisable to keep them informed. And for example, to get acceptance by shareholders to forego or defer dividend payments. Maybe to persuade existing shareholders or new shareholders, maybe to invest more money in the business. Maybe to negotiate with bankers, restructuring of loans so that they can be repaid later. And also to persuade bankers maybe to defer interest payments, maybe to defer them, say, to 3 months' time, 6 months' time, or maybe next year. And of course, you may also try and repay as much debt as possible in order to reduce future interest payments. Now, all these things are going to improve cash flow. And the impacts of those three components of liquidity and financing that we've considered must be incorporated into the cash flow forecast model. We've discussed how the cash forecast model should include, for example, the impacts of renegotiated loan financing, disposal of assets which may be surplus to requirements, deferral and abandonment of capital expenditure projects, possible sale and leaseback of assets. If you have a large number of assets for which you paid a great deal of money, you may sell those assets to a leasing company and maybe lease them back. So you generate cash flow and then you pay the leasing company installments every period, and therefore you've released a lot of cash flow. You also need to include things like changes to or cancel dividend payments, and maybe changes to tax payments if you may have negotiated with the government. And of course, the benefits from working capital requirement, reduced inventories, and changes to credit terms with suppliers and customers that you may have negotiated. The cash flow forecast model should be prepared ideally for up to 6 months, either week by week or month by month ahead, as far as you need to look ahead. And it's important, it must be regularly updated and communicated within the organization to best manage short-term cash flow. But the impacts on longer-term cash flow must also be considered to prepare as best we can for the future as we come out of this pandemic. So let's summarize the 3 key points to take away from today's webinar. Firstly, cash flow and forecast modeling. Secondly, debt. And thirdly, financial risk. Each of these areas of financial management is important, and today's webinar has identified what to focus on during this current crisis in order to improve cash flow. Cash flow, again, as I've said previously, is the lifeblood of any organization, not profit. And the cash flow forecast model is an indispensable tool, particularly in the current pandemic. The second point, debt. Debt at high levels can be very dangerous. There are many well understood reasons why so many organizations and individuals, for that matter, worldwide have continued to increase their borrowings, increase their debt to unprecedented levels. And levels of debt at the moment worldwide are at the highest level they've ever been, both corporate and individual. But many economists consider this a flawed strategy, as so many highly geared, highly borrowed businesses continue to go bust when times are hard and economies slow down. The third point is risk. All risks are increasing daily. They're increasing daily in their size and their variety. But financial risk is a very significant risk, and it's linked to increased levels of debt, but it also includes the wider areas of currency risk, trade risk, credit risk, and so on. Now, each of the topics we've discussed today and many more may be further followed up if you'd like to meet again at one of my training courses. Now, before I go, I'd like to answer any of the questions that some of you may have asked. Some questions we may need to get back to you by email. This webinar will be posted on the BASTEC website if you want to watch it again. So we'll have a look at the question mode to see if there are any questions that you've posed. One question I've been asked is that what is furlough leave? Well, furlough leave is where your employer allows you to stay at home unpaid, but you do not lose your job or your pension benefits, for example. Another question asked has been, why do people borrow so much money? Well, we talked about the reason of the interest rate being so low and money being cheap. But businesses in particular, corporate borrowing is high because businesses borrow money to finance projects and new assets, for example, because the cost of money is so low, and therefore the relative return on the project looks very high. It's much higher than it would have been without borrowing money. I have another question, and it hasn't been asked in question mode, but it's in chat, and I'll read the question to you. From the 3 key takeaways, damage caused by debt is mentioned. I want to ask if equity financing is an alternative to debt. What do you advise as a healthy debt equity mix to stay a going concern during this pandemic? That's a very interesting question, and it's a key question. And certainly, debt and equity are the two long-term types of financing. And debt, as I've said, is risky because of high financial risk. Equity is low risk for an organization because the organization does not have to pay dividend, and they certainly do not have to repay that capital. However, with equity financing, the business must aim to make money in order that it becomes profitable and that the share price increases, and also they're able to pay dividends to the shareholders. So equity financing certainly is an alternative to debt, and it is an alternative that I would advocate. I think very high levels of debt are too risky for too many organizations. The second part of your question asks about a healthy debt equity mix, and that's a very difficult question to answer. And there is no black and white answer that your debt equity mix should be, say, 20%, 30%, 10%, or whatever. It really depends on your individual organization and what your attitude to risk is. So, for example, if you're a business that does have equity, and obviously you will have equity to have owners of the business, you may also have debt, but it depends on what that cost of debt is and what the cost of equity is. Now, it is possible to calculate the cost of equity and the cost of debt. The resultant mix gives you something called WACC, the weighted average cost of capital. Now, ideally, you should be trying to get that weighted average cost of capital as low as possible, but also you need to be considering risk. So really, it's not a sort of a total answer to your question about what is an ideal mix in the current pandemic, but I would certainly say you should be aiming to get your debt as low as possible, because I feel that many businesses, as you come out of this pandemic, are going to fail if they have very high levels of debt, which they have to continue to service as we get out of this pandemic. Another question in chat is that in these areas, this era of uncertainty, is it a good idea to invest where spare cash exists? If so, what areas are good for investment in these times? Well, I'm not clear there where we're talking about corporate investment or whether we're talking about individual investment. I think if we're talking about corporate investment, well, that really, I can't really answer in terms of whatever your organization is. And I certainly wouldn't start to advise you about where to invest currently. If you're talking about individual investment, well, obviously there are a number of different sectors of the economy that appear to be doing very well at the moment, even though there is a pandemic. So sectors of the economy, for example, the health sector, health services, distribution and logistics companies, food companies, supermarkets are all doing very well at the moment. If you're asking me, should you invest in businesses in those areas? Well, maybe. The problem I have, whenever I invest in companies, the share price goes down. So, don't necessarily follow my advice about where to invest your money. Another question, and this question, let's see if we can have a look at this in the question list. Okay, the question is, do you run the risk of legal action from contractors or shareholders if you defer or cancel dividends or project respectively? Well, certainly, your lawyers will be able to answer that better than I can. There is always a risk of legal action, but not if it's negotiated. And the point that I was making really is when you're looking to try and come to arrangements, maybe with debt restructuring or with abandonment of projects. This is really from negotiation. And I've stressed the trust relationships that you really need to try and maintain with your banks, with your customers, key customers, and also with your suppliers, and also with partners in which you're involved in, say, capital projects. So shareholders, you may recommend that you are not going to pay a dividend. And it would be good actually if shareholders are also on board with that to understand the current situation and why it would be better if you defer or cancel payments of dividends. This is a big issue at the moment, and the financial press is full of articles about various companies where they have suggested not paying dividend. But the point I was making earlier again is really negotiation. It's got to really be a dialogue with all the parties that you're involved in with, whether they are bankers, whether they are partners, joint venture partners, for example, as far as projects are concerned, talking to shareholders, talking to your particularly key suppliers and key customers. If you have any more questions, please post them now so that I can answer them. If you can't think of questions to ask now, by all means, please email questions and we will get back to you with some answers. If there are no further questions, I will end this seminar now by thanking you all for joining me today, and thank you to Aztec for hosting this webinar. And by the way, a focus on business and finance is important, but also your physical and mental well-being. Please don't forget that. It's very important. And for example, getting involved with new activities, new hobbies, for example, and also plenty of exercise. So it is an important point. Business isn't everything. It's very important, but you are very important too. So I'd like to say goodbye and mas salama. You all stay safe, keep well, and look after yourselves and your neighbors, and may your God go with you. Yes, to answer the question, this webinar will be posted on the Aztec website if you'd like to watch it again. Thank you again for joining me. Goodbye.